Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stephan Clark, Chief Client Officer at the firm. Diversification doesn't mean what it used to. With the traditional 60-40 equity bond model under pressure, investors today need to think how portfolios are built. At NZ Funds, our latest research explores how overlays in gold, copper, and Bitcoin and tail risk hedging can reshape outcomes, enhancing returns while helping manage systemic risk. This morning, we'll be diving into this research through our Portfolio Optimisation presentation. From gold's evolving role as a diversifier to multi-asset overlays that include Bitcoin to Universa's tail risk strategies, we will be touching on some exciting shifts in modern portfolio construction. And I'm delighted to welcome James Grigor, investment strategist at NZ Funds, to talk about this. I'm really looking forward to this discussion, James. Let's start with the big picture. What is a 60-40 portfolio and why are many saying it's under pressure in today's market environment?
Hello, everyone. I was about to say good morning, but depending on when you're listening, it could be evening or afternoon. Look, this can be a topic that some would consider dry, but actually it's super interesting, and we're going to make it as interactive as possible in the sense between the two of us to make something that is hugely important for the outcomes of the portfolio come to life and really so everybody can get a feel for how we at NZ Funds think about constructing portfolios. I think the 60-40 portfolio sometimes gets a bit of an unfair slagging off from the industry, but it's actually done incredibly well in helping people understand what optimizing a portfolio is, what diversification of a portfolio is, and what we're trying to do, and that's get the most amount of return for a certain amount of risk. And so when we think about a 60-40 portfolio, what we mean is if you take a step back and just think about shares. So shares over a very long period of time, say 20 to 30 years, irrespective of your entry point, so you might have a bad first couple of years, but irrespective of entry point over a 20 to 30 year period, shares are going to generate between 7 and 10% per annum. And that's why they're such a marvelous thing to invest in. They compound over time. And when you're diversified enough, both geographically and across a number of different sectors, what you're invested in is taking into account new technology, getting rid of old technology, and that's kind of how investing works. You concentrate on the things that are coming up and doing well, and perhaps you have less weight or less exposure to the ones that are not. And a good example of that is tech was a small part of the investment portfolio, perhaps in the noughties and 90s. There was some tech in there, don't get me wrong, but as we progress, now tech is a dominant part. Whereas, say, an oil company, ExxonMobil used to be the biggest company in the S&P 500, and now it's 20th or something like that. So that 7 to 10% per annum over 20, 30 years is fantastic, and we all want that. But the journey means it's quite volatile because a share market has about a 16% volatility. So what that means is with 95% confidence, the portfolio of, or the index of shares, let's call it the MSCI, which is the global all market index, has a volatility of 16%, meaning it could be up 16% or down 16% with 95% confidence. And that volatility, depending on where you are in the investment horizon, can be quite difficult to handle and remain invested. And that's especially the case for people who are going to consume the capital in the nearer term. They don't have that 20 to 30 year time frame. If they have a risk profile that doesn't warrant being fully invested in shares and taking that 16% volatility. So then, so what happens? What happens in order to reduce that volatility? Well, the 60-40 portfolio came about, and 60% generally was the amount of shares invested in the portfolio, and the 40% were bonds. And what those bonds did is they reduced the total portfolio volatility from that 16% and reduced it. And that provided two great things for an investor who didn't really want that 16% volatility. One, they could remain on the journey and remain invested, and that's really positive. But instead of just having it sitting there doing nothing, that 40% in bonds was also generating a yield or an income. And so that enabled them to also have an income that was coming off the portfolio, and whether they consume that income every year or that income was reinvested sort of was dependent on each individual. But that reduced the volatility and gave them still a good allocation to shares. And that 60-40 portfolio has been, and when we say 60-40, everybody's going to have a slightly different weighting depending on their age and stage and their time frame of investing. But the generic term is 60-40. What's happening now, though, is the 40, which is made up of corporate bonds, but also a lot of government bonds, is starting to be questioned. And there's a number of reasons for that we can get into. But the 60-40 portfolio is perhaps not going to give you those outcomes that you're after, because the 40 is perhaps not the safe haven that we once expected it to be. And that's for a number of reasons. First reason is if they're government bonds, and those governments of the bonds that you're buying are heavily indebted, have high budget deficits, have geopolitical instability, then those are perhaps not as, or the volatility in those bonds is higher than they perhaps once were. But also in the sense of, or what causes bond values to change, there are a lot of external factors that are making those asset classes move around a lot more than perhaps they once were. And so you're getting volatility in the shares, and that's normal, and that's remained pretty constant. Take away episodes like COVID, the volatility of shares has remained as one would expect. But the volatility in the 40 in the bonds has got a lot more, and could get a lot more, depending on what's going on in the underlying economies of the countries that you're buying it in, and therefore also in the bonds of the corporates that you're buying them into.
So over the last few years, we've obviously had a big inflation spike, and then interest rates went up, and that caused. Is that where some of this change in volatility, or the perception around how bonds behave, has shifted?
Yeah, I think so. I think we have to be careful of not using just the last event to describe what we think is going to happen for the next 20 or 30 years. So I think in some cases it has highlighted that bonds can be volatile, and they have been. And we don't have any charts today on what bond portfolios look like over the last 5 years, but they were very volatile. But it also, what has changed and what has been highlighted, and perhaps COVID caused some of this, but not and maybe accelerated it, but not necessarily caused it, is just government debt has got a lot higher. I remember talking to our investors, or would have been 15 years ago or something, and there were questions from our investors at NZ Fund saying, do we need to worry about government debt of, say, the US? And the answer has always been, government debt is something that, we need to watch, but it's not a concern. And fast forward to now, and catalyzed perhaps that the speed at which has happened because of COVID, but I think we were probably getting there anyway because of government spending, is government debt. US debt to GDP is 125%. In the UK, it's about the same. Europe's heavily indebted. Japan is monumentally indebted, although there's a slightly different, because their personal debt is slightly less. Now, New Zealand's debt levels is actually really low in comparison. We've got about almost a 50% debt to GDP, but as individuals, we're highly indebted. But also we live in a country that's a little bit more exposed, and therefore we don't want those high debt levels. And so, that 50% debt to GDP is still high in that respect. And so that's what's changed, and that's what makes perhaps us not us, but the wider market a little bit more nervous around that stability of those asset classes. I don't want to overplay it. They are still, I'm not sitting here, we're not sitting here thinking that the US is going to default on its debt. The implications are, if the US issued more long-term debt, it's not that we think it's going to default, but when they issue that debt, they're going to have to pay a higher interest rate. You're like, you know what? That debt that you've got is really high, those debt levels. So yeah, we'll keep lending you money, US, but we want a higher interest rate. And as soon as that happens, then the government bonds you already own go down in value. And because why would you want that bond that you already hold if the government's going to give you a new bond that's got a higher interest rate? And so that causes the bond prices to go down. So that's what we're worried about. That's where the stability is. Not necessarily that the government's going to default, because the asset backing of the US government is, I don't even know what a word for it is, gigantor or something. but it's enough. But it's mega. But it's the volatility.
Yeah. Okay. That's really, really helpful. When you talked about volatility, you're thinking it over what kind of time frame? That 16% is in any 1 year? That's how you look at it?
In any 1 year, the volatility can be higher or lower, but this is over a long period of time. So in some of the slides that we'll show you today, I think the time frame is 20, 25 years.
Great. Okay. And so there are alternatives. You don't just have to use bonds and shares to build a portfolio. There's a whole range of assets available. And one way to access those assets is through what the term called an overlay. Do you just want to briefly describe what an overlay is so that we can use it as, I guess it's a building block for the rest, for the next part of the conversation?
So what's really interesting, this is starting to get into nitty-gritty, and let's try and call me out if I go in too much detail. I felt like we've gone from fun to detail already, but let's keep it high level and interesting. And when we think about an overlay, what we mean is there are other asset classes out there, not just bonds and shares. Now, I want to just highlight that my background is shares. That's where my career started. It was fourth form business studies when I set up my first portfolio. It wasn't a real portfolio, but it was a paper portfolio. And I love shares. And the reason I love shares, and the reason as an investment manager we love shares, is because they compound that 7 to 10% annually over time, over a long period of time, and they can generate and grow wealth. What a wonderful asset class. At the same time, they're really liquid. So if you want to exit them, you can.
And tax efficient.
And very tax efficient for a New Zealand investor. So we love shares. But there are other asset classes out there. And whether those asset classes are commodities, gold, and even things like digital assets, there are times in the market when those asset classes will do well. And as an investment manager, thinking about long-term investing and thinking about what happens in other countries like the US and the UK, and to a lesser extent Australia, and also looking at some of these fantastic organizations that have been really successful in growing long-term capital, like the New Zealand Superannuation Fund, like some of the sovereign wealth funds, be it in Norway and elsewhere. Why not take advantage of some of these other asset classes, especially at times when those asset classes are poised to be positioned well? And we'll talk about some specifics about why, say, gold and digital assets are interesting. But in order to get those asset classes, if you had a more vanilla platform, so if you owned directly a portfolio of shares and some bonds, and you wanted to buy something like gold, you would have to sell some of your shares in order to replace it with one of these asset classes, because if your portfolio was $100 and you wanted to buy $10 worth of gold, you'd have to sell $10 worth of shares and replace that with gold. Now, the problem is, if you expect your shares to grow at 7 to 10% a year, you're giving up 10% of that compounding growth, and we don't really want that. What an overlay is it allows us to buy some of these asset classes using futures contracts. And what that means is we can provide an exposure to those asset classes over and above the shares and the bonds already in the portfolio. And that over and above perhaps is where the word overlay came from. So if you think, I'm quite a visual person, but if you think you've got your building blocks of your bonds and then your shares, and then you've got this overlay of other asset classes over the top where you haven't had to sell your shares and bonds to get that access, but it's giving you that exposure that all of a sudden diversifies your portfolio out of those bonds and shares and allows you to generate returns in other ways. I don't know if you've got anything to add on an overlay definition.
I'm quite a visual person too. I think in the chart pack we've got one of the pictures shows how that's set up. And
good point. For those that are watching, and we're on slide 7, and we have sent out this presentation. But is this the chart that you mean?
So the idea, I guess, is it's you've got if you want to access gold, there's different ways you can do it, of course. And one way is to sell some of your existing assets and buy a gold ETF. Maybe you want to go and buy some Krugerrands or bars of gold or something and hide them under your bed. Or if you're an investment manager and you can access these overlays, and they're not really, for the most part, readily available to the public, but I think that's changing with time as investment platforms become more sophisticated. But for us, if you think about it, you can either sell some of your existing assets to buy it, or you can buy through a futures contract this overlay, which is an equivalent to selling, but actually you're not having to sell. So on the chart in front of you, do you want to try and, I guess the top bar is the most powerful one that shows it. We've in our research taken and added 10%, 20% and 30% gold and studying how it delivers. So why would someone even use gold as an asset class and as an example of the different ways you can use an overlay?
So this is the building block of this whole conversation. So this chart's, if there's any other chart in this presentation, this one's one to remember because it's a really good way of explaining things. So that middle line block is 100% equities, but you might not have the capacity or propensity or the willingness to take that 16% volatility per year. So you drop down to that Markowitz portfolio, that 60-40 of 60% equities and 40% bonds, or some combination to get the volatility that you're trying to do. And that's what sitting down with a financial advisor, that's essentially what you're trying to do. Another way to look at it is going to that top bar. And so that's back to that 100% equities, and then adding this gold overlay. And we're going to talk about the 10, 20, and 30% overlay and some interesting outcomes about increasing gold, but perhaps not overly increasing the risk of the portfolio, which is really interesting. But notice the difference between the top bar and the middle bar is the equity position hasn't changed. And so you haven't sold any equities to put gold into your portfolio. And we've done this, as Stephan said, using futures contracts. And futures contracts are a really common thing. Dairy farmers use futures contracts for milk prices. It's something that is incredibly heavily traded through massive organizations like Goldman Sachs, UBS, and through exchanges. And so it's the most liquid asset class out there, depending on what the underlying asset is. So that's what it looks like visually. Why gold? This is what I mean by this is the good building block of the conversation. So we earlier talked about, well, why are we thinking about these overlays? And we think that bonds perhaps might not be necessarily the stable income producing assets that we are used to, and that volatility might increase. And at the same time, bonds are incredibly affected by what the Federal Reserve does, or the RBNZ in New Zealand, or the Reserve Bank of Australia in Australia. I listened to an interesting podcast over the weekend actually around these independent central banks are actually pretty political, and they kind of are. So this particular, and this isn't my view, this is just our view, this particular podcast was talking about Jerome Powell didn't increase interest rates just before the election because, wanted to help out the Democrats, which was weird because he was put in by Trump. And so it just shows, though, they might be independent, they are quite political, and it's not necessarily just political from a left and right perspective. It's also political as the more debt that a country has, they want to start thinking about, or how do we get rid of that debt? And one way you can do it is inflate your way out of the debt. And how do you inflate your way out of the debt? Well, you sort of artificially, or not so artificially, create inflation. That's by having lower interest rates than normal. And so all these things that central banks are manipulating in the eyes of some people in order to benefit perhaps some people, but not others. And the problem is when you have high inflation, is that can be detrimental to some of the assets in your portfolio, especially bonds. So why not invest in some asset classes that actually do quite well or are neutral from inflation? And gold is one of those. And so gold is a store of value. I always sort of think about there's two uses of gold. There's wedding rings and jewelry and those sorts of things, and it looks nice. And they're also in components and electronics. But the actual usage of gold in its true form is not worth $3,500 an ounce. It kind of, I don't know how you measure this, but I've heard some analysis saying that gold just in its use cases is worth about $85 an ounce, and it's trading at 3,500 because the actual true usage of it is that store of value. So if you buy gold and there's high inflation, the idea is that gold isn't affected by that inflation because you're storing your value. And a good way to explain it is if you lived in a very, very high inflation country, there's good examples. Argentina was a good example a couple of decades ago, Venezuela. And well, the first thing you want to do is get rid of your local currency. So what you'd probably do is buy US dollars, but they're not that silly. So the first thing the governments do is ban you buying US dollars, because if everybody tried to do that, then the currency would literally go to zero. And so one thing that people can do is exchange their currency for gold, because they know that no matter what their government does that they like or dislike, that gold price is going to be stable vis-a-vis the currency that they're in. And so that's why gold's a interesting asset class. It's also called a safe haven asset. If everything's going wrong in the world, and we saw this in the GFC and COVID, gold is a stability asset. And so, you hear of people having gold bars in their safe at home. It's actually really common. But the problem is having gold bars in your safe at home is a cost. There's a cost to store gold, perhaps not in the amount that you might have in your, depending who you are, in your safe at home.
Very big bed.
But for an investment manager, having a safe in the office is probably not ideal. So there are some organizations that you can buy the physical, but if you can buy the futures contract, then the storage issue is not there. But also you've got higher liquidity because you can sell it any time, and also you can buy it and have it as an overlay and not have to fully fund it.
If you've got gold in your safe at home, there's also the opportunity cost, right? Which is, I guess, plays into that whole the overlay concept.
Exactly.
You're not earning anything on that gold; it doesn't pay you any interest. No. So not only have you sold a portion of your portfolio to buy it, but you're missing out on the potential gains that could have come from.
That's actually a really good point. That just to emphasize, if that gold in your safe was actually in equity markets earning 7 to 10%, and you could also own the gold through futures contract, why wouldn't you? And that's kind of what we're saying, isn't it?
Absolutely. So we completed this research, going back through how gold performed through time using overlays, and take us through what the findings were and how you think about it.
So for a moment, let's just assume we're talking about just the equities part of the portfolio. So even if of your total portfolio equities only makes up a small portion, say 20, 30, 40, 50%, let's just take that equities part of your portfolio and then assume that's 100%. And then let's see what adding a gold overlay does to that. And so first, there's two things that we look at when we think about adding an asset class or an overlay. The first one is that we think about what the returns are. So in the chart that we've got up on the screen for those who are listening, we're on slide 8, but we've got different returns of different asset classes and overlays. So from left to right, US inflation is 2.6% per annum from 2000 to 2025. So over a 25-year period, US inflation was 2.6% a year. That 60-40 portfolio we've talked about today, per annum for those 25 years, same 25 years is 5.4%. If you were just 100% equities, you are 6.2%. So then we start adding the gold overlays. So if we add 10% gold overlay to that 100% equity, so take that 6.2% of 100% equity return, add 10% gold, and that return goes to 7.1%. A 20% overlay gives 7.9, and a 30% overlay gives 8.8. So lots of numbers there. Let's make it simple. Let's go from 100% equities gives you 6.2% per annum for 25 years. Adding 30% of gold for that 25-year period gives you 8.8% return per annum. So that's a 2.6% per annum increase year in, year out for 25 years. So pretty good. But also intuitively kind of obvious. If you add another asset class, you would hope that the returns are higher. So that's great. That's a great outcome. But there's always a catch. If you're adding more to your portfolio, well, how much risk are you taking? And this is where this slide 9 sets out the returns that we discussed and the extra risk. And I want to highlight a few things that this slide really clearly sets out. Let's just stay on the return first. So I've talked about 100% shares giving you 6.2% per annum over a 25-year period. When we think about that cumulatively, i.e. from start to finish, that's a 365% return. I'll take that. Thanks very much. If you add that 30% gold overlay over that 25-year period, you get the 8.8% return per annum, which we talked about. So 2.6% more per annum. That sounds pretty good, but how do you quantify that? I sometimes find that hard to think, or how much better is that? So then if you go back to cumulative returns again, for that 25-year period, you've done 751%. So instead of 365% over 25 years, you've done 751%. So more than double the return by having that 2.6% return per year. That's pretty phenomenal outcome.
I mean, investors across the board, whether you're just humans really, find it really, really difficult to understand how the compounding effect plays out. And over a long time horizon, longish time horizon, like 25 years, you can really see it pronounced to you. Yeah, you more than double your outcome by not actually that bigger uplift in return profile. So yeah. So what does it mean for the risk side? Because it does sound like
So is it too good to be true? And the answer is no. So we talked about the volatility of 100% shares being 16.1%. So remember back to that school C maths of confidence, and 95% confidence at volatility is there 16.1. If we add 30% gold overlay, that volatility does increase, but it only increases by 1.2% to 17.3. So the variation in your return only increases either positively or negatively by 1.2%. So each year is one way you can think about it. You're getting 2.6% more return each year on average. Some years are going to be better than others. There's going to be some positive years and negative years. But the volatility each year increase is only 1.2%. So basically, you're getting a lot more return for a incremental increase in risk. And that's a really positive outcome. One really geeky finance way we think about this, and for those that do a bit of reading around this, will know this ratio. It's called the Sharpe ratio. And suffice to say, it's a risk-adjusted ratio. It's looking at risk-adjusted returns. The higher the Sharpe ratio, the better. You've got all these hedge fund managers in the US talking about their Sharpe, and this got to get the Sharpe up, and this is kind of what they mean, i.e. get higher returns for not taking a massive increase in risk. And what this is showing is the Sharpe ratio has gone from 0.39 to 0.51. Suffice to say, the Sharpe ratio increases. So really positive. So this is an outstanding outcome from an investment perspective, being able to increase your Sharpe ratio or increase your returns by taking more risk, but not as much as what the returns increase by.
And just to be clear, though, it assumes that you put money in at the beginning of the period, and then you take money out at the end of the period. And it also assumes that you've invested, doesn't take tax and other factors into account. And it also assumes that you only held the MSCI and gold. So investors might look at this and ask themselves, well, that's different from what I experienced, whether positive or negative. And there will be a whole range of factors that can play into that. Timing of cash flows, asset allocation through time, obviously the New Zealand tax code, other factors.
And it's a 25-year time horizon of a set asset allocation, as Correct. You say. So it's more of a what we're trying to explain is what it can do over the long term.
And that said, say you're a KiwiSaver investor and you are you're 40. I mean, there are a lot of KiwiSaver investors who are a lot younger than 40, and you've still got another 25-year time horizon before you're able and eligible to draw down. Now, you might want to de-risk towards the end of the period and have less allocation to growth and so forth, or into shares. But I guess the point is that 25 years on a piece of paper sounds like a really long time, but it's a very, very relevant time for investors within, I guess, the New Zealand investment ecosystem. Very good. Okay, so how did it go how did this sort of concept of using gold as an overlay on shares perform during periods of where there's, I guess, dislocation in the market? And was there because gold often zigs when shares zag, what was the outcome?
That's a great question, because the other thing, volatility is one thing over a 25-year period, and you can kind of sometimes you can hide behind that fact if you just have a long enough time frame. But what about high pressure situations? You've got and don't forget, we're just talking about the equity part of the portfolio, plus your gold overlay. Your bonds are doing what they're doing. Depending on your age and stage, you've got a certain allocation to those. How does it do in a sharp drawdown? Because we call this risk off, and sometimes in a risk off, you might have a safe haven asset, but everything goes down. And what our research highlighted is that we've taken four, events: the dot-com bust in 2000 to 2002, the GFC, which is perhaps the biggest one that we experienced, COVID, that was really sharp but very short.
When you say sharp, you don't mean sharp, like Sharpe ratio. You mean
no. I mean like sharp down. Yeah, like it was a V. We talked about it a lot in 2020. It was, and this is what we predicted, and it was a V recovery rather than a U that was slow, down and then slowly up. And then the Ukraine was it was more of a geopolitical event, but we wanted to. And it, had slightly different drivers from, say, the GFC and .com, but the Ukraine and COVID were sort of external events affecting the markets. Suffice to say, if again, we're on slide 9 for those of you that want to take a look at the slides later, but we have the different drawdowns using the MSCI and then the different levels of gold overlay. And suffice to say that in the GFC, the drawdown was actually less. There was such nervousness about the banking sector. I always remind myself about the GFC because it wasn't like COVID where someone like put a spade through a power cable and we needed to reconnect it. The GFC was frightening because the banking system as we knew it might have failed. And it was so uncertain. And, you know, there's now some great films that sort of describe and books that describe what happened. But there could have been a point in time where we're trading, you know, buying computers for chickens, you know, because the banking system didn't exist because it was all going
Parts
downhill.
of it did fail, right?
And it did, yeah. There were runs on banks and etc. And, you know, there's a reason why you have very long bank names in the US, like Bank of America, Merrill Lynch, because they have combinations of banks that had to combine. But even within that period and at its worst, the drawdown in the MSCI World Index was down almost 58%. The drawdown with the gold overlay of 30% was actually less. Now, it's still down 56, but what it is showing is that gold really did nothing. In fact, it was slightly positive. So you had a portfolio of shares that still went down 57.8, and if the total portfolio with the 30% gold overlay only went down 56, that's showing that gold is behaving very differently. Similar in dot-com boom and bust, similar in the GFC, but the COVID and Ukraine, given they were slightly different events, Ukraine being a commodity-driven event as well as geopolitical uncertainty, and COVID being uncertainty about, you know, what was going to be the drivers of global markets, given everybody had to be at home, and that scariness around the illness aspect. Even with that, only very, very slight increases in volatility. I'm talking about in COVID, a 0.1% increase in the drawdown, and in Ukraine, yeah, it was a couple of percent, but that closed out pretty quickly. And the reason why gold, I think, was slightly negative during Ukraine is because the other commodities were up, you know, 10, 20, 30, 50%. Yeah. And I think there were some investors probably selling gold and buying commodities rather than...
Not using an overlay.
Yeah, rather than necessarily worried about gold per se. So in summary of gold, you get a better return per annum and cumulatively. You get a very modest increase in volatility for getting that increased return. And on a drawdown perspective, the drawdowns are similar to what you'd get if you adjust equity. So it doesn't really affect you, and i.e. the event risk is minimal. And so if we look at, there's another slide on slide 11, just showing what the drawdowns can look like. And that's sort of a visual of what we've just described. So that's gold in a nutshell.
That drawdown analysis. So drawdown, obviously, peak to trough of when you're looking at the prices, and to work out how far down it is. And if it were to, say, decrease volatility but perform really badly in extreme events, you would question your thinking more and go, well, hang on, this is actually adding a risk that we might not want to a portfolio in particular circumstances. And so doing a drawdown analysis and looking back through these events gives you, I guess, another building block in terms of confidence, is to use a strategy for with gold in this case.
It also, when that starts to recover after the drawdown, it's going to recover much faster as well. And that's, again, a really positive part of the overlay.
So is there a thing, if 30% is kind of is the top of the analysis, is there a point at which there's too much gold? Why not go to 50, 60, 80?
Absolutely. And that's what we use, something called the efficient frontier, where there's always a combination of assets that give you the best amount of return for the amount of risk that you want to take. And our analysis that, you know, anything more than that, and you start getting you start not getting the incremental increase in return for the level of risk that you're taking, and that's that's the same across any asset class, and that's why around 30% is the right number.
Okay. And gold's not the only asset class, though, right? So at the beginning of the discussion, you were mentioning that there are other types of asset classes that can be used as a diversifier. I think you mentioned copper, Bitcoin or digital assets as a potential. How do you think about that, and where did you get to with the research? Did you look at those other ones?
So the investment team are not gold bugs. That's a term used for people that just are obsessed with gold. What the investment team is trying to do is get the best possible combination of assets and to generate the best return for a level of risk, as well as remain 100% invested in equities within the equity portfolio. Again, I just want to emphasize that everybody still has bonds. It's just the equities part we're talking about. But you want that 100% equity portfolio to compound at 7 to 10% per annum, and then have a combination of other asset classes to really increase that return and be conscious of the amount of risk you're taking. So gold's not the only asset class. Gold is a wonderful asset class. I just want to add also that there's probably going to be some people listening going, oh, that's all very well, that gold looks so good, but the last 5 years gold's done so well, so you're just data mining and it looks great, which is a great question, which we were prepared for. And so we did the analysis without the last 5 years, because the last 5 years gold has done well. And in fact, the analysis looks even better from a return, incremental return increase per annum versus the amount of risk that you're taking. And so this is not just over the last 5 years. So we took that period 2000 to 2020, and again, still looks really promising. But yeah, there are some other asset classes. So in the slide 15, what we're showing is, again, the 60-40 portfolio, the standard equity portfolio, but then a multi-asset overlay. And we've got the gold there. But what about some other asset classes? So we've got copper on the slide. And why copper? Well, copper is another form of industrial sort of cyclical asset that you can add to a portfolio, similar to oil. But copper, unlike oil, its use case is perhaps broader in some senses, but also oil and with some of the restrictions around emissions can be frowned upon, but copper is very correlated to oil, because as economic growth is strong, oil goes up and copper goes up. And trust me when I say that the correlation between the two is pretty high. And so why do you want something like copper in your portfolio, or oil, but in this case copper? Well, think when oil prices shot up really high, what happens to equity markets? Well, sometimes they can go down. That's because the forecast earnings of these companies that are using things like copper and oil, their costs are going to be higher, their earnings are going to be lower, and so their share prices go down. So if you can mitigate that by having an asset that goes up in that situation, like copper or oil, that's just going to be incrementally positive for the portfolio, but not increasing the risk overly greatly because the correlation is low.
So I might try and paraphrase that, which is there's quite a bit in there, actually. Copper, it can act as a real diversifier against external shocks to the system and growth shocks, whether external or internal. So and it's also benefits. It's a bit of an inflation hedge, really, isn't it? Benefits as the global economy grows through time, the value of copper progressively goes up, and industrialization,
And that's a good point about inflation. They kind of work in tandem. So if there's high inflation, commodities are the cause of inflation, so they'll go up. And so you get some return benefits by owning them there. But then gold is a great store of value. So when they're trying to, do they keep inflation high? What the central bank's going to do? Well, gold's going to be stable. So those two asset classes are working in tandem. Meanwhile, the companies are going about their thing. They're learning different ways to reduce costs. They're looking at different ways to increase revenue. They're maybe implementing AI. And so they're going to just continue compounding at 7 to 10%.
Yeah.
But these other asset classes are there helping that portfolio along.
And copper is also used just as, not that I'm a copper bug, but it's also used for major industrial projects, right? So if you've got China or India or other large countries spending significant sums of money on infrastructure, it's heavily used as part of that, and they can often do that when the economy isn't doing as well as you might think. That's the time a lot of these projects start coming online.
I'm a life enthusiast, so I get easily distracted.
Well, I'm not sure what's the difference between a bug and a life enthusiast.
So this is, let me be distracted for 1 second and talk about China. So we're very positive China, and one aspect is they used to be that sort of ambulance at the bottom of the hill type of economic policy, but now they are really thinking about how do we stem the causes of some of their volatility. And what's really interesting is if you think of every single house in the entire island of Manhattan in New York, every single house, if you've been there on holiday, every house on the island of Manhattan is the number of unfinished houses in China. So they've started, but they haven't finished yet. And bear with me, we're getting there. And then if you think about if you're building a house, nearing more closer to the end of that build than the start, you're putting in the copper wiring, you're hooking it up to the infrastructure outside. That's when a lot of copper is used. So if we've got the island of Manhattan number of houses to be finished in China, and it's the end part, that copper demand is going to be huge. And so that's why we like China, but that's also why we like copper. And that is showing that it's going to be, potentially inflationary in China. And so having some exposure to that is a good thing, because while the rest of the portfolios perhaps try and work out what to do because their copper prices are higher,
you get to benefit it on the other side.
Yeah,
I guess it's a little bit like, if you're, I'm just thinking in the New Zealand context, how Fonterra, until it recently sold the assets, it was had its own internal hedge through milk prices and its higher value add. So when milk prices were lower, its value add business would be
vertically integrated,
100%. Yep. And so you kind of at the same level. If you've got a whole bunch of shares in a portfolio that have inputs, then you can hold some of those inputs to benefit from and to hedge out some of the price risk. Okay, so there's copper, and then we've got a third one there. That is digital assets, or you've used the word Bitcoin, but there's not just Bitcoin, is there? And
going too far. So in this example, we've used Bitcoin. So digital assets are, again, one way to look at this is uncorrelated assets. If you get a portfolio of uncorrelated assets together and form a portfolio, then you can really get some good outcomes and returns because they're not all connected and not all driven by the same thing. I think that's relatively simplistic to think about. Bitcoin is a really interesting one. So we're using Bitcoin here as opposed to just digital assets in general. And Bitcoin has a lot of the same qualities as gold. It's a store of value. In the US especially, it's very much looked fondly upon because it can't be, I guess, influenced by government. It's deregulated, so there's a bit of influence in that sense, but its price can't be changed or messed with through interest rate policies and things like that. But the other thing around Bitcoin is that it's the swing bridge into digital assets. And when you think about digital assets and what they might be able to create for consumers around other digital assets and payments and currency exchanges and all these things, it's a technology that's incredibly exciting and uncorrelated because it's such a new asset class to just general economic conditions. So we've got gold as a store of value, copper as an industrial sort of cyclical input when there's inflation or other unique aspects about the commodity cycle, and Bitcoin, which is slightly different again, but has some of the same, I guess, makeup of gold in the sense of store of value, but also has these other drivers around technology and uptake, really, in terms of the number of organizations, people like us, that are buying it into the portfolios. And that correlation or lack of correlation, again, really adds to a portfolio without adding too much risk. Should we talk about what the outcome is?
Yeah, please, go for it.
So this is going back to what we've done here is we haven't been able to use 2020 to 2025. And the reason is if we did, that would include Bitcoin in its early years. And suffice to say, it would look incredibly attractive. Bitcoin has done 46 million% return since it started in earnest in 2009 or 10. And so it would really be skewing the numbers. So we've taken it from 2018, from when institutions could invest in it. And so in that period, from 2018 to 2025, US inflation was 3.6% per annum. The 60-40 portfolio, 6.9. 100% equities was 10.9 or 11%. Now, what about these other overlays? So if we add the 30% of gold, we've talked about that before, but in this time period, it's 14.1%. So, quite a big increase from the 100% equities. 15% gold, 15% copper. So splitting that gold into gold and copper. It's not as strong as the gold, but it's still stronger than equities. And while that return might not be as high as just having gold, we'll take a look in a second about what's happened with volatility. And then adding, instead of the just gold and copper, adding gold, copper, and Bitcoin, we've got to 17.3%. So let's summarize that. We've gone from 2018 to 2025, that's 7 years. Equities were almost 11% return. The gold overlay was 14%. Gold and copper was 13.5%, so still better than the equities, not quite as good as just gold. And the gold, copper, and Bitcoin was 17.3%. So that's quite a big jump.
They're quite big numbers, of course, and I guess it's important when you're thinking about that to remember that, one, it's a very short period of time. It's only 7 years, but it's the only period of time we reasonably could sort of undertake the assessment. And then the other piece is that as different, each of the asset classes have had a good run in that time. So that it's not intended to be to signal a lot more than that. It has really worked over that period.
And again, let's describe this in risk, though. If we are adding 10% gold, 10% copper, and 10% Bitcoin, you're getting that 17.3% return we discussed. So that's a lot higher than the 10.9% per annum return in the MSCI over that same 7-year period. And so that's 6.4% increase in return per annum. And the volatility does increase. Copper, Bitcoin are obviously more volatile assets, but it's only a 4% increase in volatility. And so when you think about the Sharpe ratio again, has your Sharpe ratio increased? Are you getting more return for a not as big increase in risk? Yes, your Sharpe ratio does increase. And so this volatility now for this portfolio goes up to 21% or 20.6%. But what that just means is that volatility is higher, but you're getting a fundamentally, a significant increase in return. And so you might just own less of this portfolio overall. So you might actually own some more bonds in the portfolio and have a more an exposure to this that's getting you that 17.3%, which is the way that we think about this and the way that we think about that increase in volatility. And so again, having these three asset classes is super positive.
Okay, so how can retail investors, for want of a better term, can they access these kind of strategies?
It's pretty difficult.
Yeah.
And it takes a long time, even for an institution like ours, to set up the ability to buy overlays through futures contracts.
Right.
For those that are in the industry will know what an ISDA is. and they take considerable amount of time. They can't be done in New Zealand, so they're done with banks globally, whether it be the US or Europe, and that's just the start. Then there's things around pricing, and there's also the expertise in trading it, which doesn't which isn't just like buying and selling a share. It's slightly more involved, and so short answer, no, it's pretty difficult for a retail investor to get exposure like this.
Okay, and then how does, I guess, thinking about in the NZ Funds context, how does this these ideas currently present themselves in the portfolios? Because this is an academic assessment, really, or research paper. It's not suggesting this is what you're going to get exactly in the portfolios. How does the investment team take this research and for the benefit of the investors with NZ Funds?
There's lots of ways to answer that, so I'm going to guess how I should answer it. No, it's basically what we want you to do is think about a New Zealand funds portfolio in three. There's the income category, and those are our bonds, and those are invested in New Zealand and Australia and globally, and those are two portfolios. You've got the cash portfolio there too, so there's three really in there. There's then the inflation portfolios, and we've talked about the inflation portfolios on this podcast before. There's 6 portfolios in the inflation, half of those in New Zealand, Australia, half of those are global, and they are your defensive shares. They have a much lower beta than normal shares, which means they go up and down less than the share market. They're usually defensive, a little bit, dare I say it, boring, pay a nice dividend though, tax efficient, especially the New Zealand and Australian ones. Those are your inflation portfolios. They're like the swing bridge from growth to income assets when we think a portfolio still needs to be compounding, but perhaps taking slightly less risk. And also they fight inflation. They do really well during high inflationary environments. Then the growth portfolios, there's 3 growth portfolios within the growth category. If you're in KiwiSaver, there are actually 3 underlying portfolios in that growth category. There's the New Zealand and Australian portfolio, and does what it says on the tin. Invest in New Zealand and Australian shares.
Yep.
There's the global shares portfolio, does what it says on the tin, it invests in global shares. It is diversified across a number of different companies and geographies. Some of that money is managed by Fisher in California, and that is the big compounding portfolio within the growth portfolio. And then there's the global macro portfolio. And what that is exactly what we've been talking about. That is 100% invested in MSCI shares. But then it also has the overlay that we've been talking about. And at the moment, the overlay is gold, copper, and digital assets, similar to what we described. And that portfolio provides that, I guess, incremental increase in return for not taking too much more risk, and that provides that diversification and the overlay that we've been talking about today.
Fantastic. And so if you are in our KiwiSaver scheme, for example, generally speaking, our KiwiSaver investors are in what we call our life cycle strategy. There's, some people will be on different bespoke allocations. And so within the life cycle strategy, there's a meaningful allocation to our growth category. So there's the 3 portfolios that you mentioned at the end there: New Zealand, Australian shares, global shares, and then the global macro portfolio. And within that global macro portfolio, you would have the exposure to these different overlay strategies. So it's a small part of a bigger allocation. And it does. I mean, the role is to act as a diversifier and add a wedge of additional value, risk-adjusted value through time. When you think about overlays and how they might be used, do you see that changing in our portfolios or more generally across the investment universe, KiwiSaver in New Zealand, because it is very common overseas?
I think it should. Whether it does here, I think there's a bit of obsession with simplicity. excuse the pun on both both name and what I meant there is that this is something that NZ Funds we've been working on for many years, but the results speak for themselves in terms of what this can provide a portfolio, and I think that over time you'll perhaps see it used more, but not at the moment. No one else really in New Zealand uses it other than those organisations we talked about, like the Super Fund, who have a team of hundreds, and they'll have a team within there somewhere that are doing these overlays. But what I think is important is that, and I guess to conclude all of that, is you need to remain curious about generating returns because things change over time. We need to be conscious that different asset classes going through different political, economic, geopolitical events means we need to constantly think about what else there is out there to invest in, both to protect assets, but also to grow them in an environment that might not be, what it was 10, 20 years ago. And so that's what we're always looking for. And we don't have to be there. We can have no overlay if we don't see any outcome that's positive. And there'll be times in the cycle where we won't have an overlay. We'll just love shares and own shares. But there'll be times like now where it is profitable for our investors to have the overlay, and we'll be invested in that global macro portfolio.
Fantastic. Thank you, James. It's exciting to have it sort of explained so cogently.
I hope we lived up to this is going to be exciting and fun.
Well, you do your best, but you've certainly done that. Thank you, everyone, for joining us, and we look forward to the next NZ Funds Monday call. Have a great week.
Thanks, everyone.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.